Andy Brenner is with us. He's the head of international fixed income securities at Natalliance, and of course the author of the much read newsletter. Andy, good to have you on the show here. So everybody's calling this a non-event today. I take a little bit of issue with that because we're only a couple meetings removed from a saving batch of cuts to keep us at bay from a weakening economy. So what are you looking at today?
Ollie, we don't think there's going to be any change in raises or cuts today. We think we're going to take a look at the dot plots, which are going to tell us what the next move by the Fed looks like a year out. We think the next move by the Fed is going to be a tightening, but well after the election, so we don't expect much for next year. But we think the dot plots will give us a little bit of a hawkish read, and I think that might cause a little bit of curve flattening, but not much. I think the bigger issue here is what the Fed says or doesn't say about the repo market. They've been behind the eight ball now for about 3 months on the repo situation, and they still don't have their arms around it. And one other thing that we think is interesting that we will guarantee that the Fed will not talk about is the fact of how much they're quantitatively easing right now. The Fed's balance sheet in the last 3 months has risen at an annualized rate of over 28%. And even in M2 money supply, it's rallying. It's been up over 11% in the last 3 months annualized. So you know what, Ollie? They're really adding a lot of stuff. And they may say it's not QE, but they're clearly in a QE. They're not buying securities except for bills, but that still is a QE. And that's something we don't think the Fed's going to talk about. And it's all because to reverse the mistake they made over the last year and a half, which ended in August, of tightening, of quantitative tightening, which they said was not going to have any effect. It did have a major effect, and the Fed's trying to backpedal from that now. We think there's more going on behind the scenes that will be announced in the press conference today by Powell.
So, Andy, is that the reason for why bonds and gold bugs and bond bulls continue to be holding on for the last 2 months, despite the fact that we've slipped from highs in both these safety assets? Any sign of weakness, and there still is a rush of buyers here. Is it about the repo stuff? Are they looking for potential trade breakdown? Because I do see a case in which that old thing at the beginning of the year where bonds and stocks doing something different, I got to say it looks a little bit more compelling now to where stocks do have a different vision of the future than these bunker assets do.
Well, you just asked me about 4 questions at once. So is some of the gold and some of the rally in the equity markets due to the fact of the Fed is quantitatively easing? Yeah, I think so. And that's part of it that most people don't understand. How does this look going forward? Are stocks and bonds telling us a different story? Absolutely. The stock market is still very much bullish and very much, continuing to see inflows. Actually, they're seeing outflows, but there still is more buying than selling. So, take that for what you may think. Again, we think that's part of the quantitative easing thing. But the problem we have about the stock market looking forward is, the CAPE ratio that Schiller came up with years back that got him a Nobel Prize, cyclically adjusted PE ratio, that's above 30 right now, or around 30, and the average is 17. So I would say that stocks are going to have a real hard time going up a lot going through the first quarter of next year. I wouldn't be surprised to see a correction. But as far as your inflation thing, yeah, the CPI number today is running above 2. I think it's 2.2 or 2.3. You have copper now. It's just this morning. It's gone above its 200-day moving average. And if you look at what oil's done, I heard you talking about it in the last segment. Oil's up, crude, is up 30% this year, according to what I just looked at. So there is inflation out there. I think it's going to be ultimately bad for the long end of the bond market, but we're not going to see that today, and we're not going to see that out of the Fed. And the market also has its second eye on the trade talks. Everyone seems to think December 15th we're going to have a deal done. Ollie, December 15th is only 4 days away, and I don't see any real movement here. The Chinese don't believe that tariffs will be implemented, and Navarro made some comments last night saying, if no deal, tariffs will be implemented. Ollie, again, 4 days away, and no one's anticipating it.
Andy, when you talk about some of the signs of improvement in crude, I also put copper in the realm too of cyclical assets that have been doing better. to bring it back to bonds again, I mean, maybe Powell will not be the impetus for a major bond sell-off, especially if he keeps talking repo stuff or doesn't have good answers for it. But if and when there is some kind of conclusive evidence that our economies are not only not falling a cliff and not only stabilizing, but maybe actually rebounding, what is the concern then for bonds? I mean, should you be looking at upside potential for the 10-year that could get out of hand quickly? Because again, there just seems to be so much resilience despite more and more parts of the market signaling global economy is getting better.
Right, Ollie. I think what we're looking at and what we're predicting for going out, not necessarily day-to-day thing, is we expect the curve to steepen and steepen dramatically. We think the weakness will come in the long end. It's not evident now. There's still a lot of fear. If the trade deal falls apart, you could see a flattening first. You could see 10 years break through the 180 and break through 171 and get all the way down to 1 5/8. On the other hand, 2% isn't that far away. And if what happens, if what happens is what we think will happen, then we're looking at a 10-year above 2%, and we're looking at probably 10-year bonds approaching zero, which is about a 30 basis point move from where they are right now, sometime in the first quarter. There isn't enough left in the end of this year to get us to those numbers.
Okay, so we've got now an outlook for the future Fed that looks a lot different than the trailing one, and I hear this in your tone as well about the next move being a hike, but very far out. Is that, by your judgment, Andy, what you see from the trading activity at Natalliance and your pulse on the market? Do people expect that? Is there any thought that there's still potential for deeper and lower rates from the Fed? Because I do hear this from a lot of portfolio managers we talk to and a lot of strategists that are very comfortable being long duration. They don't believe there's any potential for inflation. But I'm not sure if the inflation part necessarily means we don't have a Fed that has to get a little bit more hawkish.
So what I think is going to happen, Ollie, again, you're asking me a whole bunch of questions. What I think is going to happen is the Fed's going to stay where they are. They're not going to ease rates. I don't care what people think right now, that unless you have a total collapse in the market, and Ollie, look at last week's unemployment number. That was a blockbuster number. Anyway, soup to nuts. I mean, you had over, between adjustments and the actual number, it was over 307,000. So, I mean, the economy's doing well. You're at 50-year lows in unemployment. I don't care how you calculate it. Things are good. So there's no recession. The Fed's not going to ease rates again. What will happen is all this apathy, as what you just said, guys are comfortable with long rates. I think they're going to be caught off sides, and I think they're going to be caught off sides dramatically. Again, it doesn't happen right away. You have to have at least phase one done and an outlook for Trump winning the election and a reasonable phase two. But we're seeing green shoots across Europe right now, and we may be early in this, but we think the economies of the world are going to get better. And as they get better, we think the long end of the rates, especially with the Fed on hold, the long end of the rates are going to be the ones that get hit and get hit the hardest. So that's why we're looking for a steepening.
All right.
So, yeah, a lot of people seem to be complacent, but you know what? It's not going to change my view.
Okay. A lot of questions, a lot of answers. Andrew Brenner, great to have you here. Appreciate you joining us this morning. Thanks, Andy.
Thanks.
You got it. Andrew is the head of International Fixed Income Securities.